Two people can have the exact same 4% mortgage rate and make completely different decisions, and both can be right. A 35-year-old may want that extra money compounding in the market. A 46-year-old may be looking at a mortgage that won't disappear until their mid-70s. And somebody who's 58 may care less about squeezing out another point or two of return and much more about the income they're going to need once that paycheck stops. That's why I think the usual argument, my mortgage is 4%, the market may return 8%, so invest the difference, leaves out a big part of the picture. Now, later I'm going to show you something I always do with my mortgages. I use an amortization schedule, almost like a scoreboard. I want to know not just how much principal I had paid down, but how many months or even years I had knocked off the mortgage. Because the payoff date matters, but so does your age when you finally get there. Let's start with somebody who's 35. They may have 25 or 30 years before retirement. That gives invested money a lot of time to compound and recover from bad years in the market. So that may push the decision more towards investing. But paying a little extra on the mortgage can still have value. Maybe they don't even know how long they're going to be in the house long term. A great job opportunity could come along in 3 or 4 years and require them to move. Paying a little extra towards that mortgage builds that equity cushion a little bit faster. If the house hasn't appreciated much, that extra equity could help absorb some of the cost of selling and reduce the chance that they're stuck or that they have to bring money to the closing table. Now, you could keep that extra money outside the house instead, I get that. But if there's a realistic chance that you're going to need it in just a few years, I think I'd much rather have it somewhere conservative and liquid and not taking much of a stock market risk. Now, take somebody who's 46 and just bought a house with a 30-year mortgage. If they make nothing but the regular payments, that mortgage could still be there when they're 76. Well, maybe they'll still be working then. I mean, my handyman's 78 and still going strong in between his heart attack and his vertigo. And then again, maybe they won't. And that's the point. At 46, you can't just ask whether your portfolio might outperform the mortgage rate. You also need to ask whether you want that payment following you into the years when the paycheck may not be there anymore. Now, take somebody who's 58 and getting close to retirement. Well, this changes again. I've seen what can happen when somebody retires without enough cash or conservative investments to get them through a bad market. Back in 2008 and 2009, I saw people who still needed money to live on while their stocks were just getting hammered. They had to sell growth stocks that were falling in value. Now add a mortgage payment on top of that. At 58, getting rid of that fixed expense may be worth a lot more than simply asking which option has the higher expected return. So age doesn't give you the answer, but it absolutely changes the question. Now, let's get into the basic math. If your mortgage is 4.5%, putting extra money towards the principal gives you a benefit that's roughly equivalent to a guaranteed 4.5% return. Now, assuming you're not getting a meaningful tax benefit from deducting the mortgage interest. Now, investing may earn more over time, but it's not guaranteed. One gives you a predictable benefit by reducing debt. The other gives you the potential for a higher return. And that 4.5% mortgage benefit may actually be worth a little more than it looks. The interest you avoid isn't taxable income. So if you're comparing that with a taxable investment, that investment may need to earn more than 4.5% before taxes to leave you with the same result after taxes. Now again, if you're getting a meaningful mortgage interest deduction, that can change the math some too. But for a lot of people taking the standard deduction, that 4.5% is a pretty clean, guaranteed benefit. And for a 46-year-old, every extra dollar going towards principal is also moving that payoff date a little bit closer. Now, I wouldn't prepay so aggressively that I give up liquidity, ignored expensive debt, or sacrificed an employer match towards retirement. You still need flexibility. And that's one reason I usually preferred a 30-year mortgage over a 15-year mortgage. And I've had both. Most of the time, I like the 30-year. Not because I want to take 30 years to pay it off. I like being required to pay less and then choosing to pay more, even if it did have a slightly higher interest rate, because none of us know what tomorrow is going to look like. Number one rule I learned a long time ago: life is not fair. My mom and dad bought a house a few years before I was born, had a mortgage on it. My dad got in an accident when I was a year old, passed away, just like that. Now, obviously, I was too young to remember, but I do remember some of the aftermath, and that stuff stays with you. So for me, if something unexpected happens, I can always fall back to the required payment. With a 15-year mortgage, that higher payment is still due whether life cooperates or not. So let's say my actual payment was $1,530. In my mind, maybe it was $1,700 right from the get-go. That became my payment, day one. The lender only required $1,530. So if something happened, I still had that lower required payment available. But mentally, from day one, I treated the extra amount like it was part of the payment. That way, I didn't have to make a new decision every month about whether I was going to pay extra. And this is where that amortization schedule becomes important. I like to use one from bankrate.com. Now, it's not perfect, but it works. I'd print it out and keep track of where the balance was supposed to be. Now, let's say about $250 of a regular payment was going towards the principal. If I added another $125, then roughly every 2 months, I was knocking out another month's worth of scheduled principal. Then I would write the actual balance right on the amortization schedule, and I'd date it. Over time, I could physically see how far ahead I was. Now, of course, gradually I'd have to bump up the extra I sent in because the principal being eliminated was also getting larger. If I had knocked out 61 payments, that wasn't just a lower balance. That was more than 5 years. Now, I could look at my age and see when that mortgage was really on pace to be gone. And that meant more to me than looking at a mortgage statement every month and just seeing the balance move a little bit. There's a psychological impact looking at progress that you're making at a glance on your noted up amortization sheet versus your monthly statement that's just showing incremental decreases in the balance. Now, one practical thing here. If you're making extra payments, make sure the servicer is applying that extra money to the principal, and check your loan terms for any prepayment restrictions. Now, here's the part that I think some people underestimate. Paying off a house is not like paying off a car. It can take years to finally get there. But once you do, the cash flow difference can be substantial. If your principal and interest payment was $2,000 a month, that's $24,000 a year you no longer have to come up with. That doesn't create income, but it does reduce how much net income that you're going to need. And if you're approaching retirement, that matters. Especially if part of your plan is living off of Social Security, a pension, dividends, or portfolio withdrawals. Now, let's give the investing side full credit here. If you're investing that extra money consistently for 15 or 20 years, compounding could build an account large enough to pay off the mortgage later and still leave money invested. And that's a very real advantage. And if you're reinvesting dividends along the way, well, those dollars are compounding too. But the word consistently matters. You actually have to invest the money. You can't spend the difference. And you have to stay invested through bad markets. And that can be tough for some people. There's also another issue if you're building that portfolio with the idea that you'll eventually use some of it to pay off the house. The investment strategy shouldn't stay the same forever. If that payoff date is 20 years away, you have a lot more time to recover from market declines. As that date gets closer, I'd want that risk tied to that specific money coming down. Because this is the same problem I saw with people, what they ran into in 2008 and 2009 that I talked about earlier. The problem isn't simply that the market can fall. The problem is having the market fall right when you plan to use that money. Otherwise, you may have to sell at a bad time, delay paying off your house, or change your plans. And this is why two investors with the exact same mortgage rate can make completely different decisions. One may have two incomes, a pension, Social Security, dividend income, and a substantial portfolio. The other may be getting close to retirement and depend heavily on withdrawals from that portfolio. For the first person, carrying a low-rate mortgage may not put much pressure on the plan. For the second person, eliminating that monthly payment may be much more valuable. Same mortgage rate, different financial life. There's also a strong argument for keeping a very low fixed-rate mortgage. Inflation. If your principal and interest payment is $1,800 today, it's still $1,800 15 years from now. Hopefully your income has gone up over that time. And those future dollars, well, they're worth less. So a 3% or 4% fixed mortgage can become easier to carry as the years go by. That's one reason I wouldn't automatically rush to pay off really cheap debt. Then there's the psychological side. For some people, watching that mortgage balance come down and knowing the payoff date keeps moving closer means a lot. There's comfort in knowing a major debt is disappearing. That doesn't automatically make prepaying mathematically better, but it doesn't make that feeling irrelevant either. And this doesn't have to be an all or nothing decision. You can keep investing and still pay extra on the mortgage. Maybe when you're younger, more of the extra money goes into a portfolio. As retirement gets closer, maybe you start directing more towards the house. Or maybe your portfolio gets large enough that carrying the mortgage doesn't concern you at all. The strategy can change because your life changes. So when you're deciding whether to invest that extra money or put it towards a mortgage, don't just compare two percentages. Look at your mortgage rate. Look at your age. Think about how long you realistically expect to keep working. Look at the liquidity you already have. Look at the income your portfolio and other sources may provide later. And then ask yourself one more question. When do I want this mortgage out of my life? There isn't one answer that works for every investor. The important thing is that the mortgage fits your life plan, not the other way around.